In today's video, we'll talk about what is derivative market. There is a form of trading called as derivative trading. Derivative trading is one of the most interesting forms of trading that brings excitement to the space of stock market investments. A lot of variables apart from the stock price or market trend are in place while you indulge in this trading form. Let's discuss at length about how it works for traders while starting with the basics. Derivatives are the financial contracts that derive their value from the underlying assets. The underlying assets in this case can be equity, commodities, indices, currencies, rate of interest, or exchange rates. The value of a derivative depends on the value of its underlying asset. Thus, by predicting the future price of the asset, the future price of the derivative contract can be judged and traded on. Derivatives are one of the most complex financial instruments and the most rewarding ones too. Derivative trading is the trading mechanism in which the traders enter into an agreement to trade at a future date or at a certain price, after understanding what the future value of the derivative is expected to be. Derivative trading is a perfect place for both long-term investors and short-term speculators. It is a normal buy and sell process, but instead of paying the entire money, only an initial margin amount is paid to the stockbroker and the balance can be paid on settlement. Derivative trading can be of the following types, depending upon the conditions of the contract: future trading, forward trading, options trading, and swap trading. In future trading, the parties to a future contract have an obligation to buy or sell the contract as a predefined price and time, and conditions remain standardized. In forward trading, the parties to a future contract have an obligation to buy or sell the contract as a predefined price and time, but the conditions are customized by the buyer and the seller according to their requirements. In options trading, the buyer of the options contract does not have an obligation but an option to buy or sell the security at a predefined time and price. In swap trading, one cash flow is fixed and the other is variable and based on an underlying like interest rate, currency exchange rate, or index price. As mentioned above, derivative trading is of multiple types and each type has its own set of rules towards trade execution. Let's take an example of future trading under this form of investment so that you can easily grasp the concept. Futures are the contracts which give buyer a right but not obligation to buy an underlying asset. That may be stock, commodity, etc. in future at a price decided today. For example, if I have predicted that Nifty will reach 7,000 after a month and today it is at 6,500 points, I can enter a futures contract with a future seller to buy one lot, that is 70 units of Nifty, after a month at 6,800. So if Nifty actually reaches 7,000 after a month, then seller needs to sell it to me at 6,800, which means I am in profit of 200 times 70 units. The futures are bought by not paying the whole value but only a limited amount of premium. If Nifty goes lower than 6,500, then the seller of the futures contract is in profit and he or she gets to keep the premium put by the buyer. A future buyer needs to refill the account each day if he or she is going in loss to keep the contract alive. Options. Options are also contracts which allow users to buy or sell call and put options. A call option is bought when the prices are expected to rise and a put option is bought when the prices are expected to fall. A call option is sold when the prices are expected to fall and the put options are sold when the prices are expected to rise. In options, there are no obligations to fill a loss-making contract each day. Now let us talk about derivative trading strategies. Depending on whether you are using options or future form of derivative trading, and even within that whether you are going for put options, call options, etc., there are multiple strategies that can be deployed. Some strategies come with mild risk while others bring in very high risk based on the market volatility. At the same time, a few strategies come in with limited profit potential, while there are some that come up with unlimited profits too. Here are some of the most commonly used derivative strategies: covered call, protective call, long call, bull call spread, long strangle, short strangle, and there are hundreds of other strategies that can be applied in your derivative trading. Thus, it is strongly recommended that you understand some of the major ones and start applying those in your trades to see the differences in your takeaway profits. Derivative trading timings. Stock market trading happens with a specific time period on a business day. As far as derivative trading is concerned, different exchanges such as NSE, BSE provide this form of trading on weekdays. It is not allowed on weekends, that is Saturdays and Sundays, as well as on national stock market holidays. Now in the end, I'd like to give you some derivative trading tips. If you are relatively new or even an old time in derivative trading, here are a few tips that must always be considered while performing this form of trades. Keep your eyes wide open while looking at parameters such as strike price, premium, expiry date, current market price, etc. Use margins as per your risk appetite only. You might be looking to jump your profits, but it can hurt your trading capital as well as in case the market goes south. Do not trade a contract that you do not understand. Knowing the fundamentals and asset movement is the basic that you must be in the know of. If you are a beginner level trader, start small. Do not fancy high expectations looking at what other traders are doing and saying, and invest in options as a small percentage of your overall investment portfolio if you are an initial level trader. You can visit our website StockQuantum.com for more information with regard to trading topics, and thank you so much for watching this video.